And there you have it, the closing bell of the New York Stock Exchange. It started off as a rough day for the stock market, but the Dow Jones Industrial ticked back up and ended the day relatively flat.
Right, the S&P 500 and NASDAQ ended up with slight gains. We're now joined by Gregory Daco. He is the chief economist at EY-Parthenon. Welcome to you. So what was driving the markets today?
Well, I think what we're seeing in terms of the broad economy is a sense that things are perhaps going to be okay after all. We may not necessarily be heading into the recession that was feared all along. And that's because in part we've seen some easing of inflation, which should allow the Fed to stave off its very high and large rate hikes. So we're probably going to be in an environment, at least for the foreseeable future, where we continue to see a slowdown in economic activity, but perhaps we'll avoid the feared recession. I think markets are taking that in stride.
U.S. Treasury Secretary Janet Yellen told Congress today that the country will hit the debt ceiling next week with this new Congress. So is there a real concern that lawmakers won't vote to raise the ceiling in time? Or what could this do to the Wall Street and most certainly to the economy?
Well, I think there's certainly fear around the debt ceiling because we've seen that in the past, failure to raise the debt ceiling in time has raised financial sector volatility and has led to stock market losses. We're currently in an environment where we have a divided Congress and uncertainty, especially in the House, in the wake of the difficult election for the Speaker. So we're going to be, over the next few months, next few weeks, in an environment where we're approaching the debt ceiling. The date at which we'll reach that debt ceiling is probably going to be January 19th, according to Treasury Secretary Yellen. But Treasury will use some extraordinary measures to provide itself a little bit more wiggle room, probably through the summer. Depends on tax returns over the tax season. But in that environment, we're likely to see increased financial market volatility and worries about the potential breach of a debt ceiling, which would in itself bring about a recession from one day to the next.
All right. Well, you wrote an article, Gregory, for Barron's outlining how the U.S. may be on its way to avoiding a recession. So what economic factors have gone into your analysis?
Well, I think there are really three key factors that might prevent a recession globally. We are in an environment where we're seeing ongoing resilience in terms of business investment activity in the U.S. We're also seeing the labor market remain relatively resilient, with the value of talent being much higher than it was pre-pandemic, and businesses really holding on to their talent. We're also seeing that in Europe, warmer weather, while it is a concern from a climate perspective, is helping give Europe a bit of a free pass in the context of its energy crisis, and could potentially avoid a recession there. And then finally, in China, while there has been the abandon of the zero COVID policy, sudden abandonment of that policy, and that will weigh on economic activity in the near term. Fast forward 3 months, and we could be in an environment where mobility increases, along with natural immunity and stronger consumer spending. So we could be in for stronger economic activity over the next 3 to 6 months, and perhaps avoid the dreaded global recession.
It's fascinating to hear about how these geopolitical events could really kind of come together. It'll be interesting to see exactly how that dynamic plays out here. Gregory Daco. Gregory, thanks so much for sharing your insight with us. We appreciate it.
Thank you.